Hey everyone, welcome back to our channel. If you have ever wondered how the stock market works or wanted to start investing in stock market but didn't know where to begin, don't worry. You are in the right place. No complicated jargon, only simple explanation. I will try to explain it as simple as possible. So today we are breaking down the basics of the stock market in simple, fun and easy to understand way. So grab your tea and let's get started. So let's start with the basics. What is the stock market? Picture it as a massive online marketplace like Flipkart or Amazon, but instead of buying clothes or gadget, you are buying tiny pieces of the company which are called stocks or shares. So stocks and shares are nothing but these are tiny pieces of the company. Just like you buy a shoe from a store and after that you own it, similarly, when you buy a stock of particular company, you are owning a small part of that company. If the company grows, then there is high chance that the value of the stock or share will rise, as a result of which your investment will grow. But if it struggles, it might fall as well. So there is high chance that the your investment will grow, but there are chances also that it might fall. So in India, the stock market operates through mostly two main exchanges known as Bombay Stock Exchange or BSE and the National Stock Exchange or NSE, similar to online store like Flipkart or Amazon. The BSE Sensex index tracks the top 30 companies, while the NSE Nifty 50 tracks the top 50. So Sensex means what? It represents top 30 companies in India. And what does Nifty 50 represent? It represents the top 50 companies in India. These, these indices are like a report card for the market wealth. When you hear Sensex is up by 500 points, it means the stock market is doing well. And you might have heard the term like bull and bear. So if the Sensex is rising, then you can consider it as a bull market. But if the Sensex is dropping, suppose instead of Sensex is up by 500 points, it has dropped by 500 points, then in that case, the market is called bearish market. So why does this matter? It's because owning stocks can help you grow your wealth. Suppose you have bought the shares of Reliance and say Jio launches a new 5G plan, then its stock price might rise. Then your investment grows too. But if the company faces challenges like a bad quarterly result or their competitor do well in the market, then their price will decrease. For example, instead of Jio, suppose Airtel launched a new 5G plan, then there is high chance that Airtel price might increase, but Jio share price will decrease. As a result of which Reliance share price might get affected. So next question is, why do companies sell their stocks? Of course, to raise money. When a company wants to grow, say to build new factories, to fund their R&D, or to pay some debts of the company, or try to expand it globally, it needs funds, right? Then how to get the fund? Then it can sell share to investor like you and me. And for the first time, when the company tries to sell the shares to retail investor like you and me, it come up with an initial public offering, or you might have heard the term IPO. That is the time when company goes public for the first time. For example, when Zomato went public in 2021, recently it raised billions through its IPO to expand its food delivery and grocery services. Investor who bought Zomato share became part owner and bought and bet on its future growth. But remember, if company doesn't perform, share price can fall too, like Paytm IPO, which launched its IPO at a price of 2150 rupees. But after listing, it dropped gradually and dropped heavily until 340 rupees, a price drop of around 80%. And if you do not have any idea about what is an IPO, you can check our previous videos on IPO Masterclass, where we have described in simple terms everything you should know about IPO from basics to analysis. Means how to analyze an IPO, when to avoid an IPO, uh, when to apply for an IPO in simple way. So the link of that video is given on the top. So don't miss that video as well. So in long term, once the company start earning more in return for investing, you might get dividends. There is another term which is nothing but like a interest. Suppose you want to save your money in a bank. After fixed time, the bank pays you some interest, right? Similarly, in share market, that is not called interest, but that is called dividend. In long term, once the company start earning more in return for investing, you might get dividend. That is a share of the company's profit paid out regularly, like a thank you bonus. It is similarly like a profit or the interest in bank account. For example, suppose you have a fixed deposit account or a saving account, then regularly you will get interest on your saving. Similarly, if you own a stock of a particular company and the company announce dividend, then dividend amount will be credited to your account. And many blue chip companies like ITC or TCS, they pay consistent dividends, but not all companies pay dividends. Newer firms like Paytm might reinvest profits to grow it faster, hoping to boost their stock price instead. So you can earn through dividends or by selling your share at higher price later. So next we'll learn how does the stock market work. The stock market is driven by supply and demand, just like any market. If everyone wants to buy a share of a hot stock like BSE, the price will shoot up. If selling picks up, the price will go down. It's like bidding at an auction. Imagine you own a clothing business and suppose you have 10 t-shirts. Then if there are 100 customers, they want the same design, then you can increase the price and sell it at a higher price. In stock market, it is like that. If there will be more demand, then the price will go up. If the demand will be less, then the price will go down. Is this the only factor? The answer is no. There are dozens of factors on which the price of the share can change, like company earnings or economics news like GDP report or even budget announcement, or if there will be a new RBI policy. Those are the various factors that can matter. And even if there will be a global events like there is increase in oil price or there is change in US market because of some of their policy, it can affect the Indian stock market as well. Let's break it down with an example. In 2023, when the government pushed for green energy, stocks like Tata Power and Adani Green surged because investors saw growth potential. But when global market crashed due to US interest rate hikes, even strong Indian stock took a massive hit. So the Indian market can feel like a Diwali firecracker, exciting but sometimes unpredictable. That's why understanding indices like Sensex and Nifty is the key. They show the market's overall mood. A rising Sensex signal optimism, while a falling Nifty might mean caution. One more thing, trading happens from Monday to Friday from 9:15 a.m. to 3:30 p.m. to various brokers like Zerodha or Grow or Angel One. You place order to buy or sell and the exchange match them. If your bidding price matches with the seller price, then you can buy. It's like you are bargaining in a market, and if the seller wants to sell at that same price, at some price, and if you want to buy that thing at the same price, then there will be a transaction. And instead of like going to a market, all this buying process of share is done digitally. So no more shouting trader like in old Bollywood movies. If you do not have a broker account like online account for buying or selling shares and confused where to open an account, you can check out our previous video on comparison of various stock broker. Next, let's learn some must-know terms to navigate the Indian stock market. Don't worry, I'll try to keep it as simple as possible. So first of all, what is stock or share? These are nothing but a tiny piece of the company. Next, what is a Demat account? So a Demat account is your digital wallet for holding the share, like a bank account for stocks. And next term is nothing but the broker. So a broker is a platform like Zerodha, Grow or Upstock that lets you trade stocks. It's like a Flipkart or Amazon account through which you can buy different appliances or gadgets. Similarly, by using this broker platform, you can trade stocks or buy or sell the shares of particular company. Next, we will learn about what is portfolio. Portfolio is nothing but your collection of investment. That is, if you have invested in 10 different companies, everything as a collection of all your investment is called portfolio. Next, we'll learn about dividend. Dividend is like a profit payout from the company account to the investor account. Imagine if you have 10 share of Infosys at 1500 rupees each. And if Infosys announce a 20 rupees dividend for share, you get 200 rupees which will be directly deposited to your bank account. And if the and similarly the share price will be adjusted, means 1500 rupees the share price will go down to 1480 rupees. And after that, if the share price rise to 2000 rupees, your shares are now or 20,000 rupees, an increase from 15,000 rupees. So remember, don't choose companies only on the basis of dividend. So why do I say so? Take example of a Coal India. It pays dividend regularly, but if you check the share price of Coal India from 2010 to 2020, almost the share price has decreased by 66%. So you should choose the stock having clear growth story, but don't choose the stocks on basis of how much dividend you are gaining. If your share price will increase, automatically your investment will grow. Dividend is just a small part, so you should never choose the company based on how much dividend they are paying. All right, are you ready to invest? Here is how you can start your investing journey. First of all, you have to open a Demat and trading account. So for that, you can open your account in apps like Zerodha, Grow or Angel One. And remember to link your PAN card, Aadhaar card and bank account. So once your Demat account is ready, you can start investing. So remember, you have to always research before you start investing. Start with companies like Reliance, Tata or HDFC Bank or SBI Bank. Check their financial, look at their revenue, profits, various news on money control or BSE India, or go for index fund like Nifty 50 ETF for a safer bet, which spread your money across top companies. And if you are the beginner, always start with small amount. You don't need lakhs to invest. Many stocks like those in small cap companies cost less than 500 per share. Even if in large cap companies, there are a lot of companies whose share price is lower than 500 rupees per share. Even 1000 rupees can get you started. Consider systematic investment plans like SIP in stock or mutual fund for regular small investment instead of directly jumping into buying shares if you don't know anything about that. And always think long term. The stock market isn't a get rich quick scheme like pesa double in 20 days. That is very risky. Historically, the Sensex has grown about 10 to 12% annually over decades. Invest for goals like retirement or a home or for your kids' education, or if you want to invest like for more than 5 years or 10 years down the line, then it's better to invest in stock and use market dip as buying opportunity if the stock is good. Remember when the Sensex crashed in March 2020 due to COVID, Savvy investor bought stocks like SDFC at a discount and they sold it. Then the share price increased after that. So invest when the market falls. Invest always in good companies. So there are some golden rules for beginners. First of all, you don't need a lot of money to invest. Start small. Invest in what you understand. Don't follow rumors or tips like WhatsApp tips or tips from Telegram channel. Like they promise that they can increase your money like 2 times, 3 times in few months. Don't believe those rumors. And always diversify your portfolio. Don't put all your money in one stock, like in or in one sector, like in IT sector only or in FMCG sector only. Always you have to remember, always diversify your portfolio, and it should not be too much as well. And always think long term. In the next session, we'll learn about what are the risks and rewards. So investing in Indian stock is exciting, but it comes up with huge risk as well. Price can drop due to inflation, global event like US rate hike, or domestic issues like a weak monsoon. And to manage the risk, always diversify your portfolio. Don't put all your money in one stock or in one sector like tech sector. Spread it across different sector like banking sector, IT sector, or chemical sector, or auto sector. The Indian stock market has huge potential. With a growing economy, stocks like those in Nifty have delivered strong returns over time. For instance, if you have invested 1 lakh rupees in Sensex in 2000, it would have over 14 lakh today, despite its ups and downs. So always think long term and always do your homework. Avoid various scam like promising like guarantee return. If it sounds too good to be true, it probably is. So always avoid market scam. Investing is a journey, so always start small, be patient, and keep learning. That's all for today. If you loved this, hit that like button, subscribe, and ring the bell for more videos. Happy investing. Bye bye.